Hello, this is Joe Pryor, the virtual real estate team in Oklahoma. It's the middle of September, and all eyes are on the Fed. The Federal Open Market Committee is going to be meeting again this month. We just saw the inflation numbers. It was down, but it was expected to be 8%, and due from the high of 9.1%. But the projection was about 8.1, but then it was 8.3. Which means that it looks to the Fed that inflation is still persistent. And it makes them more aggressive than they have been even in the past. At one point, we thought that it was going to be a 50 basis point increase. Okay, get a little bit increase in the mortgage rates, it's going to be okay. Then the latest thing is it went to 75 basis points, and some people are predicting 100 basis points with another increase coming before the end of the year. So what the Fed is doing is putting a whole lot of bad medicine in there. And this is going to affect us all. It's going to affect those of you who want to buy a property to live in for your very own. Because right now rates are typically about 6.5%. It looks like they may be 7.5%. If you're an investor, it's going to be even higher. And so one of the things that we have to look at is what do we do on down payments, for instance? So for instance, going 25% down as an investor versus 20 is one of the ways that you can reduce the interest rate. The second thing is paying discount points and on 25%. Now above 25%, there's no difference. It just gives you more equity and it's going to lower your payments. So we are seeing investors that are going 25 to 40% down at this point, mainly because what they want to do is fix in that fixed interest rate. Now, the other thing that's a prediction, and I hope this is not true, is that the Fed believes that inflation is going to be going through 2023. There are some economists saying that we may not see relief until 2024. Again, this is going to bring up the idea of adjustable rate mortgages, mainly because if you can get one that's fixed for 3 to 5 years and get a rate that really makes sense for your investment, then the idea is to refinance once rates go down. So you kind of use the adjustable rate as bridge over troubled water. And I think what we're going to see is more types of corporations, insurance companies, whatever, are going to be putting out money for these non-qualified mortgages. And we're going to see some better rates in that particular respect. I like the old ways, I like the lower interest rates, but the most important thing is getting a fixed interest rate. But if we can get an adjustable rate, and I'm still looking to find something that makes sense. As of today, it does not. But I think it will, then what we can do is get something to give you that bridge over troubled water so that you can refinance in the future, get that rate down.